Gentlemen, and welcome to this webinar brought to you by fxstreet.com. This is high probability forex trading entries and exits. And my name is James Chen. I'm the Chief Technical Strategist with City Index Group. Now, I'm all too glad to be back here at FX Street giving these webinars. I've just been on quite a long hiatus for several months because I've been doing a lot of traveling to our different global offices, giving seminars and talks and stuff like that. So glad to be back, and hopefully this becomes more of a regular thing. Now, just a few housekeeping notes. If any of you are in the New York area and will be around on February 6th in New York City, I will be doing an FX Street FX meetup. If you want the details on that, please feel free to contact either me this is my email address right here, james.chen@cityindex.com, or you can contact the good people at fxstreet.com, and they'll be very happy to provide you with all that information. Also, later on in the month, also if you're in New York City, I will also be at the Traders Expo in New York. I'm not sure about the dates on that. I think it's somewhere in mid-February. So if you're around for that, love to meet you, and we could talk. Okay, so again, my name is James Chen. I'm the Chief Technical Strategist with City Index Group. We are based in London, and currently I am in the U.S., but I do a lot of traveling to London and our other offices globally, whether it's in Australia or Singapore or China or the Middle East or what have you. So if any of you are in those markets, I'd love to come out and meet you one of these days. Okay, so let's get started real quick. Very quickly, before we get started, a quick disclaimer. Financial trading carries a high level of risk to your capital with the possibility of losing more than your initial investment and may not be suitable for all investors. Ensure that you fully understand the risks involved and seek investment advice if necessary. Just going to leave that up for a few seconds, and then I'll answer the questions as we move along. If any of you have any questions, please feel free to type them into the chat window, and I'll be more than happy to answer them. Jake, when in Singapore? Singapore is actually, it should be pretty soon. Within the next several months, I should be showing up in Singapore, but it hasn't been set down yet. We're looking to have a big seminar out there with several of our speakers, including my colleague Ashraf Laidi, as well as myself and several other people. So looking forward to that. Hi, Juan from Madrid. I was actually in Madrid last year. Not sure if I met you there, but if I did, good to see you again. And Boyke, as always, thank you for the welcome back, and I'm glad to be here and glad to see you again as well. Okay. So let's move forward real quick. Now, today what I'm going to try to do is I'm going to be giving you some background on how I trade. I haven't done this with FX Street for quite some time, so I'm going to be going through some of the fundamentals and basics of what I do as a forex trader, as well as what I do when I'm trading other markets as well, including the equities markets, indices, commodities, etc. But I'm going to be giving you my, my approach to trading these markets from a technical basis, and then I'm going to go straight to the charts and show you all the examples that I can, and show you what is actually going on right now. As we all know, right now we are waiting for the FOMC statement or announcement that will occur in just about 3 hours from now, around 2 p.m. Eastern time, so we're going to be waiting for that. I'm not going to do this webinar during that time, but you can be sure that I'm going to be looking at what's going on and possibly acting upon anything that does happen. But as you probably all know, for any of you who have heard me or spoken with me or listened to me before, I do try to stay away from market moving events like that. But you could be sure that I will be watching it. Okay, so very quickly about me, before we get started, I am, again, James Chen. I am the Chief Technical Strategist of City Index Group. We're based in London with offices around the world. And I trade, I analyze, and I educate, much like what I'm doing now. I've been an active trader and analyst in equities, indices, futures, commodities, and forex for over 15 years, and I use primarily technical analysis. I am a chartered market technician, and I publish daily market analysis for major financial media, and you'll be able to see that as well on our website at www.cityindex.co.uk, as well as our satellite websites around the world. And I've appeared regularly on many different financial media networks. I've also authored many different articles, and I'm the author of 2 books, Essentials of Foreign Exchange Trading and Essentials of Technical Analysis for Financial Markets, as well as with FX Street, the DVD set High Probability Trend Following. So that's basically about me. And again, if you have any questions during the course of this, please feel free to type them in on the chat window. Okay, so today's topic, as I mentioned, high probability forex trading entries and exits. For those of you who've heard me speak before, I'm going to be bringing up, my main points about how, or my main perspective as to how I trade the markets. If you've heard this before, there's probably a good reason for that, because my approach has not changed. I'm trading from a technical perspective, and the tools I use and the techniques I use pretty much stay the same. But what I'll do is I'm going to give you all that background, and then I'm going to go to my charts and show you exactly, what I'm looking at. Okay. So, very quickly, in terms of the simple, I'm going to go through this really quick because, this is, and then get to the real charts. But very quickly, my main principles for entries and exits is simply, if you want to enter a trade, the best way to do that is in the right direction at the best possible price. Now, what does that mean? I'm always looking to trade with the trend. Now, recently, as you've probably seen on, at least on the currency pairs, we've seen a lot of chop, okay? But at the same time, we're still within strong trends on many of the different currencies. And the case in point would probably be Aussie dollar, Australian dollar against the U.S. dollar, as well as the U.S. dollar against Japanese yen. And we've seen a pullback there and a possible opportunity there. As well as to a lesser extent on the euro dollar and the pound dollar. Actually, to a lesser extent on the euro dollar, but the pound dollar has seen lots of strength, and we're in a very strong uptrend on that. And then I'm also going to be talking about gold, and then also I'm going to be going into the indices, including the S&P 500 and the FTSE, which we've seen, as we all know, if you pay attention to the markets at all. Extremely strong trends, but at the same time, recently we've seen pullbacks. Now, whether these pullbacks become full-blown corrections, and corrections are usually defined as more than a 10% move, a pullback move, that whether we see that or not remains to be seen. But right now, we are at critical junctures on many of the different currency pairs as well as the indices, and I'll show you all that in a minute. Okay, so again, one way to enter a trade is the right direction of the best possible price. So what does that mean? The right direction for me is in the direction of the trend, and a lot of people ask me, what if the market is not trending? Well, you could always find a market that is trending, although there are oftentimes prolonged ranges or trading ranges, but at the same time, you could always find strong trends, and we could see that all across our charts, which I'll show you in a minute. Okay, so the right direction at the best possible price. What is the best possible price? That is simply, what I look for are pullbacks, and we see that on many different trading instruments, including, as I mentioned, dollar yen, Aussie dollar, etc. So we're looking for trends, and we're looking to trade the best possible price. In this case, this would be pullbacks. So, for example, if we're in an uptrend, we're looking for pullbacks to the downside to take advantage of good prices there. If we're trading short in a downtrend, we're looking for rallies to trade short the rallies, because those rallies represent the best possible prices to get into those trends. So it makes a lot of sense, and this is exactly how I approach it. This is how I enter a trade, the right direction, the best possible price. Now, equally important, or some people may even say even more important, are how you exit a trade. Now, number one, none of us like to have losses, but losses are a part of trading, so they should be accepted. Now, how do we trade at a loss? Well, we want to be able to close out our positions where the market tells us that we are wrong, and I'll show you exactly what I mean by that. And in terms of profit, which we're all going for, preferably we'd like to have our profit at a multiple of our defined risk. That way, you don't have to have a phenomenal win-loss ratio in order to make money, in order to be consistently profitable. So if your profits are larger than your risk, or at a multiple of your risk or your stop loss, then at that point, you'll have a better chance of becoming consistently profitable without a phenomenal win-loss ratio. Hopefully that makes sense. Okay, so that's my basic trade entry and exit principle. Now let's move on. And my market principle, and a lot of you have seen this before, and I'm just going to show it again because this is the way I trade. So it's called TPB, trade TBV, which is trend pullback breakout. I'm simply looking for a trend, number one. Okay, as you can see down here, number one is the trend. Number two, I'm looking for any type of pullback. Remember, I'm looking for the best possible price to enter into that trend. And number three, I'm looking for a breakout. And what does that breakout represent? That breakout represents a resumption of the trend, back in the direction of the trend after the pullback. So in essence, what this breakout means is that it's giving indication that the pullback is recovering and going back, and price is going back in the direction of the trend, in this case, uptrend. So again, we have the trend, we got a pullback, and then we got a breakout, and that breakout is an indication that perhaps this pullback is ending or recovering, and price is once again going back in the direction of the trend. Now we can see that readily on several different charts, especially the indices. Now we don't know right now if the indices like the S&P 500 or the FTSE or any other index is going to turn into a larger correction and perhaps become more than just a pullback, but that remains to be seen. But I'll show you my charts in a second on how we might look to play that. Okay, so we have a breakout here, and then once we have the breakout, we can place our stop loss. And again, where's your loss? Your loss is where the market is telling you you're wrong, and this little red line right here is where the market is telling me I'm wrong. After I get into this blue breakout line right here, that breakout, I'm getting into a long trade. And then I have my stop loss, or whether it's a mental stop loss or a hard stop loss, where the market is telling me I'm wrong, and that's that red line right there. That means once I get in on this blue line on the breakout, if price comes down and comes back down and breaks and takes me out right at the red line, that is telling me that I was wrong. So the market is telling me that I was wrong to get into that trade. Maybe I got in too early, or maybe it was just the wrong trade altogether. I tried to get in on a recovery of the pullback. Maybe it wasn't a recovery of pullback. Maybe the market is coming back down and it's turning into a reversal or an even deeper pullback. And at that point, I need to get out. And that's where the market is telling me I'm wrong. That's where I place my stop loss, whether it be mental or hard stop loss. And once we have that in place, then we have our risk. We have our defined risk. And this is with this red bracket right here. Once we have our defined risk, and once again, let's go back here, the profit, preferably at a multiple of your defined risk. Okay, so once you have your defined risk, then you could have your reward, and preferably this reward will at least be larger or equal in size to your risk, or larger, or a multiple of your risk. Okay, and that way, again, you don't need to have a phenomenal win-loss ratio in order to be consistently profitable. Okay, so that's my main market principle, TPB, trend pullback breakout, and the underlying principle throughout all this is risk control through stop loss. Okay, now I show this a lot of times. This is just a visual depiction. This is a chart, historical chart. It just shows a perfect case scenario. Okay, so you have an uptrend, number one. You have a pullback, number two. This pullback comes back to the line, and then we have a breakout here. Okay, so this breakout is breaking out above this counter trend resistance line. Okay, so that is a possible entry level. Okay, so you go in long there, and then you place your stop loss below the low of the last pullback. Okay, and that means that if price comes back down and takes you out there, that's the market telling you that you're wrong and you should get out. Okay, if not though, you have your defined risk here, you have your entry here, you have your stop loss here under the low of the last swing low. Okay, of the last this last swing low of under the low of the pullback, and then you could have your reward right there. Okay, your profit target. Okay, very quickly, Gabriel, do you always have a fixed target, or sometimes do you leave a runner? How do you decide what of the two to do? If you could give an example. Okay, that's a great question. I only have about 30 minutes left here, so that I could talk about for another hour or two. But just to give you a quick summary of what I do. So, do I have a fixed target? Oftentimes, I will have a fixed target, but at the same time, oftentimes I will have a stop loss that I move. Okay. And other times, what I'll do is that I'll have multiple positions. So let's say you have a trade with 2 or 3 positions. Let's keep it simple. Let's say 2 positions. Okay, 2 positions in a trade. So you're going long at the same price for 2 positions. One of them you could have a fixed target, and the second one you could run it and have a higher target. Okay, so that's a possibility. Other ways you could do that is you could move your stop loss. You could trail your stop loss. I like to do it manually, but that again is is a subject for another time. Okay, yes, I will oftentimes have a fixed target. James, what is your usual risk-reward ratio? Depends on my strategy, James. But oftentimes what I'll have on a couple of my strategies, especially my short-term strategies, is a 2-to-1 ratio, which means 2 times my risk. My reward is 2 times my risk, which means my profit target is 2 times my risk, my stop loss, or my defined risk. So that's oftentimes what I'll have. Johnny, how do you find out that it's a pullback or a reversal? That's a great question. Pullback or reversal, you don't know. Okay, so right here. You get in on a breakout right here. Let's say, if you take a look at this chart here, you get in on a breakout, you go long on that breakout, you have your stop loss here. Now, let's say it subsequently comes down and takes you out of that trade. That means it could be turning into a deeper pullback, or it could be turning into a reversal. So you don't know. Okay, you have to follow the market. You can't. There's no way you could predict whether this is going to be just a simple pullback or a reversal. Now, that being said, this breakout is giving me some indication that perhaps momentum is going back in the direction of the trend. It's giving me some indication. Is it a guarantee that this will continue in the direction of the trend? Absolutely not. Okay, so you don't know what it's going to become. The best you could do is you could put in your entries, your risk, your defined risk, and your defined reward, and that's all you could do. Okay, James, it's asked. Question at Q&A. Do not say that. Okay. What was the yellow line, please? The yellow line, I'm sorry, the yellow line is simply a moving average. Okay, great. All right, so let's move on there. That's my general principle for getting into trades. Now, I'm going to go quickly through this. I only have a little time here. I trade with confluence. What does confluence mean? Confluence is simply putting together my different tools and techniques. And I'm going to show you all my tools and techniques really quickly, and then I'm going to go to the charts. So what is confluence? And, you've probably heard me like a broken record talk about confluence all the time, but this is exactly how I trade, and this is exactly what works really well most of the time for me. So confluence is simply, I'm putting together, whether it be different time frames or technical tools, support and resistance, chart patterns, etc., putting them together, and if everything is pointing, or if several different aspects of my trading techniques are pointing in one direction, let's say pointing up, okay, then at that point I have a stronger conviction that the market is going up, and at that point I will look to get into a trade, okay? So confluence is agreement of my different technical tools and techniques. So where possible, we're going to look for areas where more than one factor provide rationale for a trade entry, and the more rationale there is for a trade, the higher probability that trade will tend to be. Okay, so this is what I look at. First and foremost, I look at trends. Okay, so I have these illustrations here of this uptrend and this downtrend. Now, this is an uptrend support line. This is a downtrend resistance line. Trend lines are good because they help you frame a trend, but just the fact that a trend line is broken or that a trend line is respected does not really mean that much, because trend lines are very, very unforgiving. So it's difficult to trade based upon trends. If you're thinking, if it breaks through the trend, then that means it breaks below the trend in this case, let's say, then that means it's a break of the actual trend. It's usually or oftentimes it's not the case. So it's very difficult to trade based upon trends alone. That's why I use confluence. Okay, so I use many different factors, not just trend lines. I know a lot of people that like to use exclusively trend lines. It's very hard to do that because they're very, like I said, very unforgiving. Just because there's a bounce or there's a breakout of that trend line, as we can see on, let's say, euro dollar or pound dollar, just because there was a break does not necessarily mean that there was a break of that trend. Trend lines are very good at framing trends, but to trade based upon them alone is very difficult and usually does not work so well. So, but trends are extremely important in helping me to frame what direction I'm looking to trade in. Okay, so that's trends. Support and resistance, extremely important. Okay, so in terms of confluence, my top two techniques or tools, whatever you want to call them, are trend and support and resistance. So what is support and resistance? For those of you who don't know, you should definitely know this. For those of you who do, most of you should know what this is. Support is simply a floor. Resistance is simply a ceiling. And support is where price, or where you may expect to find more demand. Okay, so demand means that price will go up or should go up. Okay, now resistance is where you might expect to find more supply, which is where price should go down. And we could see that in many, many cases. Let's look at gold in a few minutes. We'll look at gold and we'll look at that double bottom low at around 1180. In terms of resistance, that was beautiful resistance. I'm sorry, support. That was beautiful support. That was a beautiful floor for gold. Okay, it was almost to the dollar on gold. So does support and resistance exist? Absolutely exists. It exists. It's not just a coincidence. Support and resistance are extremely strong in terms of, or extremely good for using for trading. So very important. Now, you have support here. So again, it's a demand level. So where you can expect to find more demand and price may go up. Now, if there's a breakout of that, breakdown of that support, then that's just telling you that something fundamentally is occurring that is strong enough to break that support level. And therefore, theoretically, we're looking for follow through in the direction of that breakout. Okay, of course, that doesn't always happen. We see false breakouts all the time. But in many different cases, if you see very strong support and then you see a breakdown, okay, something fundamentally is happening that perhaps is making, and I'm not talking about news. I'm talking about something fundamentally on a broader basis is happening that is strong enough to break that support, and therefore we're looking for a directional move in the direction of the break. Same thing with resistance. Resistance, you should see a lot of supply at a certain level. Okay, if that level is broken to the upside, then something fundamentally is happening where you have a break of that resistance, something stronger than that resistance is occurring, where we're looking to play in that direction. Okay, so support and resistance, very important. Pullbacks and retracements, I just showed it to you. We're looking for the trend. We're looking for pullbacks. We're looking for good entries within the trend. Okay, ranges, these occur often. Most of the time, I'm looking to play breaks of ranges. Okay, I'm looking to play where ranges break, whether to the upside or to the downside, rather than within a range. Although, oftentimes or sometimes you'll see ranges, large enough ranges that are prolonged enough where you could play the, between support and resistance. Okay, but generally speaking, I like to play breaks of ranges in the direction of the prevailing trend. Okay, bounces and breakouts is exactly what I just talked about. You see some fundamental factor occur that is strong enough to break down below the support, and that is a catalyst for a potential trade. Okay, Fibonacci ratios. These are simply also support and resistance. It's the same thing. It's just mathematically structured support and resistance. Same thing. Okay, so why do I follow Fibonacci levels? Simply because their support and resistance are simply market psychology, where the mass market feels that a certain level is either too low or too high. That's why you have the demand at the support and the supply at the resistance. So we're looking for areas where there's supply or demand, and Fibonacci retracements and Fibonacci extensions, etc., contribute to that. Okay, so because a lot of people and a lot of traders and a lot of institutions are actually looking at these levels, so at that point, I'm looking for something to happen at those levels, whether these act as support or resistance. Okay, moving averages. Oftentimes, again, you'll find that moving averages, work as support and resistance as well. So if you take a look, for example, at the FTSE 100, I'm going to show you that in a second. The FTSE 100, right now we are at a very key level. Okay, we're right around a long-term uptrend support line. Now the confluence of that uptrend support line, as well as, I believe it's a 50-day moving average, but I'll show it to you in a second. 50-day moving average, as well as a key support level. We got a confluence there. Whether it breaks to the downside or pops to the upside, you could bet that it's going to be a significant move because of that confluence of support. Okay. Okay. Oscillators too, I use simply as oscillators being, for example, RSI, stochastics, etc. And I use those as simply confirming tools. Okay. Discretionary confluence tools, candlestick patterns, and for most of my short-term trading, I use a lot of candlestick patterns. And let me show you my favorite ones real quick. And, again, we're talking about confluence. So I'm looking to put these together with, for example, the trend, the support and resistance, the Fibonacci levels, the chart patterns, etc. So this is what I'm looking for in candlesticks. I'm not a strict candlestick trader, which means that I don't look at, I'm not like a lot of traders that just look at candlesticks and think that something's going to happen just based on those candlesticks alone. But candlesticks can be very helpful in providing you with some clues as to especially if there's going to be a turning point at a specific, let's say, a support level or a resistance level. Now, my favorite are these two right here, the hammer candle and the shooting star candle. And for those of you who heard this before, forgive me, but these are my favorite, and that's why I keep talking about them. So for the hammer candle, you have a down move, and then you've got a hammer. This candle right here, which is simply this candle is attempting to continue this down move, but then it comes back up and closes near the highs. Now, especially on a longer-term chart, let's say like on a daily chart, this is a very good indication, especially if it's near a support level. It means that the downtrend attempted to continue, came back up and got rejected. It failed near support and came back up, and perhaps there's going to be a turn to the upside. Okay, especially during trends. Especially during uptrends, I'm looking for hammer candles at support and resistance to look for a resumption of the trend after the pullback. Remember, TPB, trend pullback breakout. So let's just imagine that we have, and we'll do less imagining in a second when we look at the charts, but let's imagine that we have this pullback here in the form of these three black candles. Okay, so we got a pullback within an uptrend. Okay, and then price goes all the way down, comes all the way back up. And if that occurs near support level within this trend, then that is possibly a good indication that perhaps price is recovering from this pullback and moving back in the direction of the uptrend. Okay, so that is a very strong candle for me. By the same token, the shooting star, same thing. Okay, let's imagine again that we're in a downtrend. Okay, so we have a downtrend, and then we've got these two bullish candles that represent a pullback to the upside, a rally. Okay, and then you have this shooting star candle, which is simply this candle that goes all the way up, comes all the way back down, closes near the lows, got rejected or failed near the highs, and that for me is a good indication of possibly that price could be moving back down to the downside and resuming this downtrend after this pullback to the upside. Now, again, I'm not simply a candlestick trader, nor am I simply a trend trader, nor am I simply a support resistance trader, nor am I a Fibonacci trader. But you put them all together, and that's when you have confluence. Okay, very, very important. Okay, single candlestick patterns, multiple candlestick patterns. I'm not going to go through those. Okay, chart pattern breakouts. Okay, these play a large role in what I do as a trader. And these are some of the chart patterns that I look at. Among the most important ones are the flags and pennants. You see these all over my charts. What are these? They're simply trend. Okay, I don't know if you can see my mouse pointer here, but trend, pullback, breakout. Okay, so TPB, trend, pullback, breakout. That's all it is. Okay, it's a consolidation or a pullback within a trend. Same thing here, to the downside. Down move, and then upside pullback, break to the downside, the TPB. Okay, and that's what I'm looking for in any type of trend. Same thing with pennants, different name, almost exactly the same thing between the flags and the pennants. Okay, so the pennants, you've got an up move, you've got a pullback, you've got a breakout. Same thing to the downside. Okay, triangles, same type of thing. You have consolidations or pullbacks or what have you within a trend, and that's what we're looking for. Rectangle, same thing. Wedges, I hate to say it, same thing. Falling wedge, we have a move to the upside, and then what's the difference between a wedge and a triangle? The difference between a wedge and a triangle is very, very little. Okay, simply a triangle. Let me show you a triangle real quick. Okay, a triangle looks like this, where both sides, both the top and the bottom of the triangle are moving at different directions. Okay, different directions. So in the case of a symmetrical triangle, you have a down move on the top, you have an up move on the bottom border. On the ascending triangle, you have a flat move on the top, you got an up move on the bottom. In each of these cases, you have the borders moving in opposite directions. Okay. Whereas in a wedge, you have them moving in the same direction. In a falling wedge, they're both moving to the downside, but at different angles. Okay? Or they could be different angles, but in this case, they're at different angles, but they're both moving to the downside. In a rising wedge, they're both moving to the upside. What does it mean? Same exact thing. Doesn't matter if it's a triangle, it's a wedge, or whatever you want to call it. It's the same exact thing. You've got to move to the upside, you got a pullback move, and then you got a breakout, TPB. Okay, same with the rising wedge. You got to move to the downside, a rising wedge, which represents a pullback to the upside, a rally to the upside, finally move to the downside. Okay, same thing with rectangles. Okay, now reversal chart patterns. These are the only cases where I look where I'm looking for reversals rather than continuations of the trend. Now, these reversal chart patterns can also be used as a trend continuation patterns, okay? Which I'll show you in a minute. If you take a look at the Aussie dollar, if you have that up, I'm going to show it to you in a minute. But if you take a look at the Aussie dollar, we had two head and shoulders patterns in a row. Okay, one that reversed it to the upside, the other reversed it to the downside. The one that reversed it to the downside was a continuation move of the longer-term downtrend. Okay, and I'll show you that in a minute. But anyway, so we got head and shoulders tops, head and shoulders bottoms. We got double tops, triple tops, double bottoms, triple bottoms, whatever you want to call them. What do they all mean? They all mean that we're looking for failure. Okay, failure. So here on the double top, it hits the high, comes down, it hits another high, and that retests it, just like we've seen in gold as well, the double bottom on gold. But you see this, and it comes back to the downside. That is failure. It tried to continue the uptrend, but it wasn't able to. It hit a retest, or close to a retest of that prior top, before coming back to the downside. Okay, same thing with the triple top. Same thing with the head and shoulders. We see we see a high, and then we see a higher high, and then we see a lower high. What does this lower high on the right mean? That is a failure to continue in this uptrend move. Okay, and then we, of course, we look for a breakdown of that neckline to look for a move to the downside. Okay, divergence. I don't have a lot of time to go through this. I was actually going to show you divergence signals, but just suffice it to say, divergences are also a part of the confluence that I look at. So divergences, and very quickly, the two main divergences I look at are bearish regular divergence and bullish regular divergence. Higher high in price, lower high in the oscillator. That talks about a failure of momentum to continue to the upside. Okay, a failure of momentum. You got a higher high in price, lower high in the oscillator. That's looking for a failure to move back to the upside and a possible move to the downside. Again, just like I'm not a support and resistance trader, I'm not a Fibonacci trader, I'm not a trend trader, I'm also not a divergence trader. What I am is a confluence trader, which means I attempt to put all these together to look for high probability entries and also perhaps exits, for my trades. So higher high, lower high is a loss of upside momentum and a potential turn to the downside. If you've got strong resistance up here, that is a confluence, and therefore I would be looking for a potential turn to the downside. Okay, bullish regular divergence, just the opposite. You got a lower low in price, higher low in the oscillator. We're looking for a potential turn to the upside. It's a loss of upside momentum. Loss of downside momentum. If this occurs near support, very strong signal. Right here, we also see a doji pattern. That's another part of the confluence. Okay, so it gives us lots of clues that perhaps this is turning back to the upside, and you could get into a you could get triggered into a trade, a long trade off of that. Okay, I'm not going to talk about hidden divergence because I don't have much time. Okay, so let's go to the charts real quick and show you exactly what I'm looking at. If you bear with me for a few seconds here, let me go ahead and change the application. Okay. Gabriel, on pullbacks or rallies, do you wait for price to come back exactly to the zone or just to move towards the area as much as possible? Yeah, I'm looking for, first of all, I'm looking for a pullback to occur, but after that pullback occurs, doesn't mean, okay, that's a great question, Gabriel. It doesn't mean that I'm, if there's a pullback, then I'm going to get into a trade. So let's take a look at S&P 500. Okay. Look at this beautiful chart. This is the S&P 500 daily chart, okay? So we've got this beautiful uptrend right here, okay? This is really good. So where are we right now? What I just told you before is that we are at a critical juncture on S&P 500 as well as on the FTSE 100. Okay, we're right at the line right here. Like I mentioned before, we are not at a correction level yet, okay? So we don't have, what's normally deemed a correction, which is, more than a 10% move. We're not at a correction level yet. We're at a pullback, okay? Does this mean that right here at this pullback, to address your question, Gabriel, right at this pullback, I'm going to go long, which means I should be going long right now? No, absolutely not. Okay, so the question is, do you wait for price to come back exactly to the zone or just to move towards the area as much as possible? I'm not going to be going long until I have some evidence or indication or hint that price is moving back in the direction of the trend. Okay, why is that? Because just the fact that it pulls back, I don't know where it's going to stop. It could become more of a correction. It could pull back to this. This last resistance level around 1730, it could pull back there. It could pull back even further than that. I don't know. So I'm not going to get in on a buy trade right here, just yet until I see some evidence that perhaps this is recovering from this pullback. Okay, I'm thinking that it's going to go further down. So I'm not waiting for some point at which I'm going to go long. I'm going to be looking for evidence of recovery. Remember, TPD, trend. Okay, we got the trend. We got the pullback. Okay, we don't know if this pullback is going to end yet. So what we're waiting for is some type of a breakout to give me some evidence or some indication that perhaps this is moving back in the direction of the trend. Now, when I say a breakout, do I mean a breakout above this high? No, that's not necessarily what I mean. What you could do is you could go on a lower time frame chart and draw a counter trend resistance line. Okay. Sometimes it's easier, like here, like right over here. Okay, this was a pretty big move to the downside in the last several days, as you might have noticed, for those of you who watch the S&P. But back here, it's more obvious. Like if you draw a counter trend resistance line right here, you have points at which it's showing that after the pullback there was a breakout. Okay, in the direction of the trend, that's giving you some indication of perhaps there's a recovery. Now, if that does not happen, you've got your stop loss to care of you. But if it does happen, then you could ride this trend, and you got in at a pretty good price. Okay. So for now, I'm not getting in. We're right near the uptrend support line. We're at a critical juncture on S&P. I'm waiting for some indication of perhaps a recovery of the trend if it doesn't break down below there. Carlos. Okay, or we could take advantage of options, but I'm not going to be talking about options as of now. Is it because it is a correction preceded by an impulsive move that could push the price even further down? Okay. I'm not quite sure I understand that. Boyke, you should have parts 1 and 2 is going very fast. Okay. Not sure I understand that either. But okay, let's take a look at our currencies, because this is mostly about forex. Let's first take a look at the obvious ones. Okay. Now I'm very bearish on Aussie dollar. Okay. So what I'm looking at, and I have 2 minutes left. I apologize for talking too much, but let's look at Aussie dollar. Okay. So I'm very bearish on Aussie dollar. Now, as I was mentioning before, we had these two, what do you call them, head and shoulders patterns, okay? So first we had an inverted head and shoulders pattern. It broke to the upside. Now, if you take this, you measure from the low of the head up to the neckline, and you extend that up, it hit its target. So in this case, it worked really well. Now, this following head and shoulders pattern worked extremely well, especially for someone like me, because I like to trade with the trend. So I'm looking at this trend that fell from 106, okay, it came back here. It retraced up to, as you can tell here. See, I'm not sure if you could see it, but if you could see right here, it went down here, it retraced that up to this 50% Fibonacci level. That 50% Fibonacci level was also the head, or around the head of the head and shoulders pattern. Okay, so once we had this head and shoulders pattern, we had the breakdown below the neckline, okay, which, by the way, long hit its target. But we had a very good trade with the confluence of that 50% Fibonacci level. We had the head and shoulders pattern, okay, and then we had and it was probably also a support and resistance level, and then we had a big move to the downside. Now, throughout this time, and then we hit, I believe this was a 3.5-year low down here. Okay, so we had many pullbacks, okay, and then breakdowns, pullbacks, breakdowns, and those were all potential opportunities to get into short on Aussie dollar. And I'm still very bearish on Aussie dollar. We're near the lows, yes, but I'm looking for more downside in Aussie dollar. Let's take a look at dollar yen real quick. Okay, so yesterday what I wrote about, remarkable trend to the upside. A long period of this big triangle pattern, okay, a consolidation, and then a break to the upside. It broke above, it broke above all my targets. Okay, first target being 100, then 101.50, 103.70 to retest that high, and then 105. Above there was 108. Before that occurred, we have pullback. It pulled back right around the 101.50 level. Now it's right back around there again. I'm looking for a resumption of this. Of course, we have the FOMC meeting coming up today, which could make some, could affect these currencies somewhat. But on a longer-term basis, looking for further upside on dollar yen, towards the highs. Okay. Okay, why sometimes do you use stochastics and sometimes MACD? Great question. My main oscillator is stochastics. MACD sometimes I use on some of my other strategies. Yeah, it's purely discretionary. The way I use them are only as an adjunct tool, so they're not, they're not my main my main tools to use. But I use them, and MACD and stochastics are two of my favorites, and I sort of go back and forth between the two. That's why. Okay. So, Carlos, do you take in consideration when entering a long position the intensity of the pullback and why and when it took place? Yes, absolutely. I absolutely take into consideration the intensity of the pullback. I talk a lot about, I have a strategy called the deep pullback. I'm looking for deep pullbacks, okay? I'm looking for bigger pullbacks. Why am I looking for those? Because first of all, you get in at a better price. So let's say there's a big pullback on, what do we have here? We have pound dollar. Let's say there's a big pullback in pound dollar. I'm getting in at a better price. Provided that pullback does not turn into a reversal, I'm in a good position. Okay, so yes, the intensity of it does make a difference. Now, let me show you a little bit of what I was talking about before. Okay, here. On gold, okay, so this is the gold daily chart. We had a double bottom. Look at this double bottom on gold. Okay, this is just remarkable where it went. Okay, usually gold is very, very extremely fundamentally focused, but in terms of the technicals here, remarkable technicals. Just taking a look back here. The pullbacks. Back up to key resistance levels. Take a look at this big pullback to the upside. Went back to key resistance level and then moved to the downside. And then looking at this long-term low at 1180. This low was at 1178.86. So just a little over $1 below that. So if you think that's a coincidence, it's absolutely not. And these technicals do absolutely work if you pay attention to them. Let's take a look at, FTSE. FTSE, again, critical juncture here. This is the FTSE 100. This is the UK index. We have a remarkable uptrend here, uptrend support line. Okay, now this uptrend support line, most recently it dipped a little bit below this uptrend, and then it popped to the upside. Right now, we're right back at that level, and we're also at a confluence of that uptrend support line, the 65.35 area or so, as well as the 200-day moving average. Now, if it breaks down below there, then that's a significant break. We see a dip below there. It hasn't closed yet, but we see a dip below there. If there's a pop to the upside, then I'm looking to perhaps getting to a potential trade. But right now we're at a critical juncture on FTSE. Okay, just to finish this off real quick, let me see. Which time frame do we identify the trend? The trend. I'm usually looking at daily charts. As you see, all these charts I'm showing you are daily. Boyke, how do you handle economic data releases and news? As I mentioned often, I tend to stay away from them. If I'm in a position, in a longer-term position, and I happen to come upon the news, I'm not likely to close out that position unless I get triggered to close out. But generally speaking, I will not open a position right around the news because I'm mostly a technical trader, and around news, technicals tend to take a back seat. Okay, great. Sorry about going over time, everyone, and I'm getting a signal to end this. I want to thank all of you for all of your time today, and I apologize that I had a lot of stuff to talk about, but and maybe I talked too much, and I went over time. But thank you all for all of your time, and I'll see you on the next webinar. Thank you very much.